All right, good afternoon, everybody. Chris Lester here. For those of you that have not been on this call before, the format is we do a call every week since COVID had hit, so it's been over a year now. And we just try and bring relative and current information on different topics. One of the areas that we implemented and introduced was a monthly recap of the previous month. And that's what we're going to talk about today. So it'll be an April market recap, and really think of this as a Monday quarterback approach towards what's going on in the economy. It sort of gives us a sense of, all right, this is what has just happened, and sort of serves as a bellwether on what we see coming up. Now, that being said, we also typically have other advisors or other advisors' clients on this call. You'll see I'm wearing my Eagle Team shirt. I'm a partner in a nationwide training organization, and collectively we all share ideas, we train together, we help each other out, with client cases, things of that nature. Our approach is very educational and holistic in nature, so nothing will be sold here today. Relax, sit back, grab a cup of coffee or a glass of water. Without further ado, we'll get started. And for those of you that I can't see, welcome, and hope you're all doing well. So, this is equities section, and this is, different indices. So across the top, we have, the S&P, the Russell is in blue, which is your small caps or your small businesses. Then you have teal green across the top, which is your developed countries, European nations. Pink is emerging markets. Typically, I like to think of this as China and similar type up and comers. Then you have commodities, and I will say that commodities, although last year got beaten up, it's heavily weighted in the oil sector. So a lot of what we're seeing is not just oil. You'll see prices have started to skyrocket on building materials as well. Real estate, so these are REITs, and then gold, right? Spiders, right? So as you can see for the month, almost everything was up for the entire month, with only small caps dropping below zero and then rebounding. But between 1% and 8%, and commodities actually led the month, right? So oil is back right now. Commodities are back. And so it's something to at least take into consideration. I've been talking about inflation for years now, and this is a bellwether to sort of keep an eye on, that things could be continuing that trend. Next was real estate, and not surprising, I sort of talk to clients and advisors, and one of the things I'm hearing is a common theme is it's a seller's market. People are putting their houses on the market in this area for one day and getting 6, 7, 8 offers above asking price. So it's not surprising that people are finding that real estate investment trusts are performing well for the month. Next, we have the S&P, right? That's the market weighted cap, top 500 blue chip companies in the U.S. And the U.S. economy has proven to continue to be strong. And you'll see here as we look at the annual projection that continues to be the case. The rest of them all between 1 and 3.5%. I'm not going to read every one for the month, but let's look at the year to date. And the only laggard is gold. Last year gold was the safe haven. It may come back in the future. Does seem to be trending up from March to April. We'll see where that trend continues. That tells us that people are scared of equities or something in the market causes them to be nervous, and that they want to move to a flight to safety. And gold is typically that area. So you can see a little bit where, lost favor for the first part of the year, and now it seems to be a little bit trending up. So it's something to keep our eye on. But as far as, equities in general, again, commodities have just done well for the year. But after last year with oil prices and COVID pandemic, it's not surprising to see that we're seeing a return there. Again, you see the blue chips and the real estate investments are both doing really well. The fact that COVID restrictions seem to be lifting, vaccines are continuing to be introduced into society. We're starting to approach a herd immunity. As long as this stuff continues, all the signs are still pointing north. that we will see a continued improvement in the economy, bar any surprises. We will see some volatility as we experienced the last few days, but overall for the month of April, it was a good month. And then you can see we had European nations and then China. Everything was above the plus line, so that was very good. This is our indicator. It's what we call the three wise men. And as you look at this, there are three indicators. One at the top from left to right is what we call the RSI, or the Relative Strength Index. And that is just a measurement of, overbought, oversold. So if you look here, any place where it was overbought, it goes above this line, it's green. And then if it goes below or anywhere in between here, it goes below this band here, then it turns red. So those are just one of the three triggers that causes one of these vertical lines to appear, whether it be red means all three have tripped, or green means all three have tripped, and will sort of dictate that we should be entering either into a negative or a bear market or into a positive market. Right now, all signs indicate a continuance in a bull market, right? So we have a green line, the three indicators, but I will point out, notice that we have just crossed over into overbought. So that means increased optimism in the economy. It doesn't mean that, as you can see, there are periods, sometimes even a year, where we can have this overbought mentality before things start to slip. So we keep a close eye on it. It is by no means a perfect predictor, but it just gives us a sense of, hey, what's the heartbeat of America doing right now? And this is on the equity side. This is why we continue to encourage our clients to be and stay in the market. The area that we have cautioned against, and you've heard me talk probably ad nauseum about the bond portfolios or the income generating portfolios. If you look in general, right, on the month-to-month basis for the month of April, right, we are seeing just barely anything above 1%. The one area that people, and again, this is a flight to safety, is the 20-year Treasury bonds at 2.4%. So people are still spooked. Sometimes that's where they will go to for their safe money, Treasury yields. But when you think about it long term, anything between 0 and 2% is nothing to build a house on, right? But this is for the month of April. As we just start to pull back and we look at the year to date, now this starts to fall, hand in glove with the theme that I've been promoting since the beginning of the year, which is the entire world is looking for yield. The entire world is looking for income from milk cows. And as you can see, very hard to find, right? And that's why I've been promoting alternatives from an income perspective. I'm going to talk about next week, just another idea. But, whether they're structured notes, whether they're covered portfolio, tornado watch versus tornado warnings that I talked about, whether they're annuities, whether they're cash value life insurance, they're just something to think about other than the traditional planning methodology, which is 60% equities, 40% bonds. Bonds traditionally are an income generating portfolio. And if that happens and bonds start to get crushed, which is what, the signs and, the predictors are pointing to, especially we've heard the I word, which is nobody thought that was going to come into reality. But I heard a statistic that, lumber prices, right, building new houses and 280%. I got a client, a friend of mine, 30 years. He's a master plumber here in New Jersey. We've been friends for 30 years, owns a very successful business, has 5 to 10 guys. And we were talking this week and he goes, Chris, a copper 90 used to be 15 cents. So a 3/4 inch copper 90, which typically a plumber will use to sweat a joint to put on some plumbing, right? He goes, it's now going for $1.15. And he goes, every month I know I'm losing money. And he has to talk to his guys about going through the truck and making sure that the things that would just get thrown into a bucket from the last job are now being accounted for because they are that valuable. And it's very difficult when pricing out a job to turn around and take a material list and hand it to a client and say, hey, normally I get $2,000 for this water heater install, but now it's $3,000 because of the cost of material. So keep that in mind. These are like just signs that when I listen and talk to people on a daily basis, indicators that are sort of saying, hey, things are changing, the tides are changing, the winds are changing. So when we look year to date, I mean, everything is negative except, right, we look at the two areas. We got muni bonds, right? Your normal muni bonds and high yield corporates. High yield is another word for junk. So taking more risk just to get 1% when everything else has lost money. And then you can see that the 20-year treasury for a year to date has lost money, although it had a good month last month. And then you have your high yield muni. So both of these right here are higher risk. And so as we're trying to get that income coming in from our portfolio, just to get 1.5% to 2%, we're taking and stepping into things and, oh, no big deal. It's fine. And just because it hasn't corrected yet doesn't mean it can't. So just be careful in the bond portfolios. Again, I've preached that now for the last few months, so story hasn't changed. But this is now our three wise men on the income portfolios. So we can see here, and I talked about it last month, we were right at the point where the crossover has happened. Two of the three indicators have crossed over. So your RSI has not crossed over. It's been overbought. It's come down, but it has not triggered yet. There is no really hard and fast rule as to what will cause this to trigger. It's how quickly this drops that usually is an indicator to cause that third trigger. But these other two, the MACD, which is down here, and the moving average crossover, have both crossed over. So things tend to gravitate back towards their moving average. So if the short-term moving averages are on their way down, it's going to pull down the values of the underlying security, and in this case, their bonds. So, we've had a green line, we've had a bull run. It makes sense that, hey, listen, at some point in time, but if we know and you have some forecast that your portfolio, although traditionally has been the wisdom to balance your portfolio, like I said, 60-40, 50-50. It's what do you do with the 40% or the 50% that is likely to be set up for a loss? What can we do? And like Warren Buffett's, philosophy, number one rule of investing is don't lose money, right? So if we can have some caution here and encourage some other ideas, that's where I think the value proposition, or at least the conversation, should gravitate towards. So the last thing is the RPA. It's a recession probability analytics tool that has been created by Formulafolios. And this is actually great news. It has continued on a downward trend. And this numeric values on the left side, on the y-axis, is 0 to 100. The 50 in the middle is, if it goes above that, means that the outlook based on a lot of indicators, could be housing starts, could be CPI, inflation, could be gross domestic products, whatever. There's 100 variables that go into this calculator, and it assigns a value. If that value crosses above 50, it means, hey, time out. Let's be careful. And we can see that, last year when COVID hit, we had hit that. And then, a lot of people were nervous, but it started to plateau out and started to gravitate back, and finally fell. And now we've had good news ever since. So it's down to 11 now. That's really, really good. That sort of supports this upward trend of, the equities projections on a longer term basis. So where we had said, hey, listen, we're going to keep a close eye on equities for 2021. It's not until, the end of the second quarter, beginning of third quarter, that we could start to see things turn around. But right now, we're seeing clients that are continuing to stay invested in the market, are continuing to reap the benefits. If they have portfolios where they're generating yield, our strategies have been working well, and then bond alternatives. So that's been our analysis for the month of April. Again, I want to hope that everybody find this information helpful. These are disclosures, shows you that I didn't make up any of this information. I didn't, whether it be the S&P or whether it be an index, these are all securities laced terms, and this is my CYA. Lastly is we want to thank you, right? And if you have questions, either for me or for the advisor that invited you on the call, I would ask you, hey, just reach out. We love to help. If you've got questions, we're really here to help you to figure out what you got and then decide should any adjustments be made on a go-forward basis to help reduce your risk, to help increase your probability of having a successful retirement. This stuff is complex. I do this every day. The folks that are our advisors, we do this every day. And we share amongst ourselves as the arena is changing. We constantly are looking at ideas and strategies that are proven so that we're reducing the risk but still achieving the desired outcome. So hopefully I continue to bring value to you. If you haven't reached out and said hello in a while, I'd love to hear from you. Just because I haven't reached out to you and said hello doesn't mean I'm not thinking about you. Guys, have a great day. Thank you very much, and I'll see you next week. Bye-bye.